This is Bloomberg Daybreak Middle East and Africa. Our top stories this morning. Asian stocks gain after the S&P 500 and Nasdaq 100 finish February at fresh records. The Fed weighs data showing U.S. underlying inflation rose in January at the fastest pace in nearly a year. President Biden says he remains hopeful about a temporary pause in fighting between Israel and Hamas, but that it's unlikely to begin by Monday. Plus, in our monthly special programme, we take a deep dive into the challenges facing Nigeria's economy as the jumbo rate hike fails to stem the currency's decline. Africa Amplified is coming up in 90 minutes. It's just gone 8 a.m. across the Emirates. I'm Vonnie Quinn in Dubai, and let's have a look at how we're shaping up for the Friday trading session. Well, it looks like futures are pointed higher after the S&P rose 0.5%, the Nasdaq 1% in yesterday's session. Now, we did get that PCE inflation data, which showed really hot inflation, but we were anticipating it after the PPI and CPI earlier in the month. We also had some Fed speakers out, Oscar Goolsbee, for example, saying that we shouldn't extrapolate too much from the January data. Raphael Bostic saying it's going to be probably at least the summer before there's any kind of a thought of a rate cut. And then we also had John Williams saying that we have a ways to go before we're happy with inflation. Quick look at the 10-year yield, down a few basis points to 424.03, and not much movement in Brent. Let's have a look at this super core inflation, because this was highlighted by Fed Chair Jay Powell about a year ago, saying that this is what the Fed was looking at. Well, you can see it rose quite substantially in January. That's going to need to come down before we even can think about the Fed cutting rates. So let's check in on that Asia session now. We had some nice moves for equities, at least. Avril Hong is in our Singapore studio. Avril.
Yeah, Vonnie, pretty nice. If you take a look at the Nikkei, for example, it surged almost 2% after the U.S. data. Risk appetite seems to be improving, and the Japanese benchmark is snapping a two-session losing streak. But we also had data, jobless rates sliding, and this shows a tight labor market, which could put further upward pressure on wages, a condition for a BOJ exit, although the governor is tempering expectations for a move in March, saying the price goal not yet in sight. We're seeing the yen erasing the gains from yesterday, more or less. Flip the board, we also had data from China, official PMI showing the factory activity shrinking and in contraction, although this was more or less as expected. Investors shrugging that off, though. Equities in China as well as in Hong Kong both rising on the Hang Seng, keeping a close watch on Meituan. That's the stock that's contributing the most to the gains, and it's surging by the most in almost a year. Offshore yuan moving sideways. It did gain yesterday after that PCE data, and this was thanks to those lower U.S. yields. Vonnie.
Avril, thank you. Avril Hong there in Singapore. Stock traders then in risk-on mode as the Fed's preferred inflation gauge met expectations. U.S. stocks ending February at fresh records. Let's get to Bloomberg's chief rates correspondent for Asia and MLive contributor Garfield Reynolds. So, Garfield, we did get a little bit of a move in the 10-year there. We saw it down a few basis points after the PCE data, but we were anticipating this data, right?
Yeah, I mean, the data came in mostly pretty much in line, and those expectations were, especially on the month-on-month, were for it to stay fairly elevated, and on the annual pace, only to slightly move down. So there wasn't anything there that said, oh, the Fed's definitely going to cut soon. The main thing for the bond market was, first of all, was really that there wasn't an upside surprise. Unlike some of the other recent inflation and, for that matter, labour market data, we didn't get an upside surprise, and that meant that with that risk passed, bond traders could focus more on the idea that there was some rebalancing demand. Bonds had a very bad month, stocks had a very good one, so there were some flows there or some potential for flows there. Also, with the end of the month, index rebalancing was seen as giving a little bit of a positive bid. So a bit more of a relief that nothing really dreadful came out of the PCE data and out of the Fed speak that followed, than any real strong anticipation that the rates picture has turned a corner again.
So, Garfield, what will the market be looking for from the Fed chair when he testifies next week?
Well, I mean, one thing they'd be looking for would be whether he, for example, does, you were showing that somewhat alarming chart of the supercore, whether that's concerning him, and how he is judging things. We had this fairly positive sort of spin from most of the Fed speakers recently that yes, rate cuts are still coming. It's just we don't see them coming anytime soon. So whether there's any guidance or hints from Powell as to how long the wait is likely to be, that's going to be important. Probably seeking for reassurance, if they can get it, that the Fed is unlikely to raise the dot plots, i.e. they've said they expect to cut 3 times this year. Is that still going to be what we get in the dot plots when the March meeting takes place?
Yeah, exactly. Not long now, Garfield. Garfield Reynolds, thank you so much. That's our chief rates correspondent for Asia and MLive contributor. Joining us now for more on this is Ed Gomez, Chief Investment Officer at SGMC Capital. So, Ed, let's start on that question. If, as Raphael Bostic says, it's going to be at least the summer before we start to see a cut, if we get cuts then, is there still time for 3 cuts this year?
We've been expecting 2 to 3 cuts for most of this year, even heading into the end of last year. What's pushing back the cuts is the fact that, of course, inflation is a lot stickier. But you also have economic growth, which is not too bad. The employment number is not too bad. So you might even have a situation where things get pushed out even more. The rates markets have already corrected for this assessment. So we were at about 6 or 7 cuts at the start of this year. We're down to about 3. I wouldn't be surprised if that goes down to 2 as well. To the extent that the economy is fine, the markets don't really need any more support from the Fed on that front.
How concerning is it to you that super core inflation is staying so elevated? Can it come down in one fell swoop?
I would think it's going to take longer because the financial stimulus that the Biden administration is directing towards various sectors of the economy is actually stimulating growth. So while you are seeing jobless numbers pick up on the margin, the headlines do find that many companies are letting go people, unfortunately. You also have continuing demand. We would think, about 2 to 3 cuts would still be fine for this year. And the Fed, meaning there's a long history of them shifting their focus, as and when it pleases them. They haven't had a consistent target. I remember under Janet Yellen, there were continual attempts to move the metric that they were assessing, whenever they chose to. So I wouldn't be surprised if they focus on something else tomorrow. We believe it's a tool that they use to fixate the market on a point that they want to, but then they switch that whenever they need to.
So Ed, let's talk about markets. Can we stay at these highs that we're seeing now?
Stay and probably exceed. In fact, we've been talking about a melt-up scenario for quite some time. If you look at last year, a lot of investors held on to cash. They were happy getting the 5%. They missed out on the S&P rally. They missed out on the NASDAQ rally, north of 30%. And, to that extent, they can't miss out another year. So with the VIX as low as it is, geopolitical tensions not great but getting digested, and investors having lost out on decent returns last year, the incremental allocation is to see flows into the equity markets. And you now have this strong narrative that's developed, NVIDIA obviously taking the lead there. But at the same time, you have various other companies starting to post very, very good numbers, and that incremental flow is moving into equity assets. So we wouldn't be surprised if we have another good year on the equity markets, and we're positioned for that.
And Ed, what would your main concerns regarding this melt-up be? I mean, we are seeing some trouble in the real estate sector. Commercial real estate lender New York Community Bank Corp again yesterday saying that it discovered material weaknesses in how it tracks loan risks. And, we've had even Janet Yellen suggest that it bears looking at.
Well, going back last year to the Silicon Valley Bank episode, clearly that was a moment when everyone looked at the banks again. No one wants a rehash of 2007 and 8. But the Fed and the regulations in place, not just for U.S. banks, for global banks, is a lot tighter. The Fed has its finger on the pulse there. To the extent that there is some kind of contagion that spreads, clearly it's going to be bad news for everyone, because credit is just going to come to a standstill. You can't extend credit when you're repairing your balance sheet. You've had a Japanese bank which has taken exposures to commercial real estate in the U.S. and they've suddenly decided that's suddenly not their business, not their core competence. So you will see people who have been chasing yield, chasing returns over the last couple of years, starting to flounder as the markets hit a rough patch. But if it's not systemic, you really don't have too much of a problem.
So, Ed, what are you doing with any cash on the sidelines now, or with your positioning?
Well, we don't have too much cash on the sidelines. From the start of last year, we've had a very positive view on markets. This year we have slightly smaller, I should say, allocations to equity, but we've complemented that by owning call options on various indices and stocks that we believe are going to do really well. So if the markets sell off, we don't take the pain. If the market keeps rallying, just given how low the VIX is, it makes sense to buy that upside optionality. And we wouldn't be surprised if the market keeps heading up, and we're going to participate with our long call options. But we don't have too much idle cash on the sides.
Very nice. The VIX there at 13.4. Ed, thank you so much for joining us this morning. That is Ed Gomez, Chief Investment Officer at SGMC Capital. Well, we'll get the latest on Gaza next, as a deadly incident around an aid convoy complicates ceasefire talks. This is Bloomberg. The US Congress has approved temporary funding to avert a partial government shutdown, sending the bill to President Biden for his signature. The deal extends funds for some departments through March 8th and others through March 22nd. 97 House Republicans voted against the bill, which does not include any Ukraine aid. And President Biden says he remains hopeful about the prospects for a temporary pause in fighting between Israel and Hamas, but that it's unlikely to begin by Monday as he had originally thought. He conditioned that a deadly confrontation earlier Thursday around an aid convoy in Gaza will complicate those ceasefire talks. Joining us now is Bloomberg's Stuart Livingston-Wallace, executive editor here for the region. So, Stuart, I mean, it's no surprise that we're not going to get a ceasefire by Monday. It was always a little bit ambitious, but certainly now the picture is way more complicated.
Yeah, I mean, it was a very strange event, where he was standing in the ice cream shop and said Monday with such certainty, and it felt like he was probably the only one that had that certainty. So, yeah, no, it's not a great surprise that he's come back from that. And I think the time frame on this is optimistically weeks, probably more like months. And yes, absolutely, yesterday's events definitely complicate things. However, in the broader context of what's going, or has been going on in Gaza for 5 months, maybe it doesn't change things too much.
Exactly. Now, Israel is saying that it was looters and that it was all a big sort of maybe misunderstanding, or that, it hadn't too much responsibility for what happened. That's not what the international community is really saying for now. There's an investigation ongoing, right?
Yeah, I mean, it is a complicated one. We know the IDF has released that sort of aerial footage that we've seen, and it is very hard to tell from that what exactly is going on. We have some eyewitness testimony in our reporting from the ground, which again complicates the matter in that it's really not clear what happened. And I think it will probably take some time, if ever, before we get a clear picture of what did happen on the ground. How
realistic are these plans being put forward by Saudi for a post-war period?
I think in the context of everyone but Israel, they look very realistic, and it's certainly, I think, a reflection of everything we've been hearing from the diplomatic community, both the US, the European allies, and further afield. However, here's the sticking point. Israel has said, or more accurately, Netanyahu has said, that that's not something he's willing to contemplate right now, particularly with regards to a permanent ceasefire and particularly with regards to what a Palestinian state might look like in the future. So there's an impasse here, basically between Israel and I think the feeling within the Israeli political community. and everyone else, or almost everyone else.
Feels like it's too soon for Israel, right? Stuart, thank you so much. That is Stuart Livingston-Wallace, Executive Editor here in Dubai. Russian President Vladimir Putin has warned that NATO risks triggering a nuclear war if it sends troops to Ukraine. He made the comment in his annual address to an assembly of lawmakers and officials. Joining me now is Bloomberg's Bill Farries. So, Bill, we've heard Putin use nuclear saber-rattling several times. I mean, it's his kind of go-to, right? But at least since the start of the war in Ukraine. Is there anything different this time?
Well, you're right. Ever since this war started, he has, over time, talked about the potential use of nuclear weapons. He made quite a show of supposedly sending tactical nuclear weapons to Belarus, where they could be more easily deployed on the Ukrainian battlefield. But that would also be a complete game changer. This time, I think he's responding to very interesting and surprising comments by France's Macron, who surprised even some of the allies by suggesting that French troops or European troops, essentially NATO troops, could at some point be sent into Ukraine. That, of course, would put them in direct conflict with Russian troops and would basically embroil NATO in a far more direct way in this conflict, potentially sparking a much wider war. So you see Putin pushing back on that. There are some people who say Macron was actually doing NATO a favor and by talking about this in kind of a vague way, contributing to some of the kind of the strategic ambiguity about where this war might go.
Bill, at the G20, finance ministers failed to issue a concluding statement over Ukraine and Gaza. What can we say about the divide between the West and the global South, given these, events are not leading to any kind of conclusion?
Yeah, so this was a meeting. It's been hosted by Brazil. President Lula of Brazil has obviously been very outspoken against Israel in recent weeks for its conduct in the war in Gaza. I think you're going to continue to see the polarization of these two big conflicts, Gaza and Ukraine, start to bleed out into all kinds of other affairs. Remember, this was a meeting of finance ministers. Ideally, I think those officials would rather not be talking about geopolitical issues like war, but the reality is that those geopolitical issues are bleeding into the economic realm, and it's making it part of their business. The longer these conflicts go on, the more I think you'll see this occurring, interfering with other issues. The heads of the G20 are set to meet in Brazil in November. It could be a very different global picture by then. It could also be very much what we're seeing today. So I think that's going to be a continuing tension for the months ahead.
Bill, thank you so much for joining us. That's Bill Farries there in Singapore. Plenty more still ahead right here on Daybreak Middle East and Africa. This is Bloomberg. Mike Novogratz, Galaxy Digital's founder and CEO, says crypto assets are at very frothy levels. This after Bitcoin surged to its highest price in more than 2 years. Novogratz adds he wouldn't be surprised to see some connection or correction even, but still expects the cryptocurrency to end the year much higher.
This is probably the first time in the history of Bitcoin that we have true price discovery. And what I mean by that is this is the first time that anyone who wants to buy it has easy access to buy it. And so, right, baby boomers have $85 trillion of wealth. Their wealth is, for the most part, managed through registered investment advisors who now, at least half of them or some portion of them, can just buy the ETF. And so you're seeing, a step function in new owners of Bitcoin, which is driving, I would say, a frenzy in the whole crypto ecosystem, right? So how crypto always works is Bitcoin gets bought and some people sell a little bit to buy Ethereum and they try to play the catch-ups and the altcoins. And I would say we've gotten to very frothy levels. You can see it in the funding rates of the altcoin market, how much you get paid to actually lend out your coins in Bitcoin, Ethereum, and all the alts. And so you saw it in the equities, the public equity markets, right? MicroStrategy, Marathon, all the kind of public equity bellwethers really went parabolic along with Bitcoin. And so I wouldn't be surprised to see some correction and some consolidation. but I'm very loath to pick a Bitcoin high because I really do believe this is price discovery. Will we test the old high? Most likely. And you'll probably have some consolidation. But I still think we're going to end the year much higher.
It's interesting to hear you kind of come in with some caution in the middle of this euphoria. It begs the question, what's also the new low?
You know, we broke out from 45,000, you know, and so that would probably be what should hold us if there's a real correction. You never know why corrections come. Something happens and people, you know, shift mindset. And there's a lot of people that have bought recently. I don't think it'll get there, quite frankly. I think if it corrects, it probably corrects to the mid-50s before taking off to the new high. You know, first the old high, that 68, 69,000, where we got pretty close. But I do think then you're going to see, and partly this is, you know, if you look at Fidelity or any of these big platforms that have so much baby boomer wealth, just shifting 2 to 3%, 1 to 3% of those assets, encouraging their customers to shift to Bitcoin over time, which has been an amazing diversifier, is a monster number.
Mike Novogratz there, Galaxy Digital founder and CEO, speaking to Bloomberg's Shonali Basak. So let's take a look at markets now and where we stand headed into the Friday session across the Middle East, Europe and the US. Bitcoin maybe just coming off the boil a little bit. It is still well above $61,000 a coin, though. It's repairing some declines from earlier. It was down almost 1% at one point earlier on. Ether up about 0.9%. As you remember, John Bollinger saying he doesn't see any reason why Bitcoin shouldn't continue this rise. That's the chart of Bitcoin year to date, up 44%. Let's take a look at equity index futures now. We have them pointed higher after a session yesterday, which saw the S&P rise about 0.5% and the Nasdaq 1%. And there you just saw the indexes across the Middle East. The Tadawul All-Share Index up for a third day. It was up 0.2%. Telecommunications stocks leading that market higher. Again, the index up 7.1% for the month. Let's move on to Treasuries after we saw the PCE inflation data coming in, matching expectations, but pretty hot. It was the fastest rise in January in nearly a year. As you can see, the 2-year yield at 4.61, the 10-year yield at 4.2430. It came off by about 4 or 5 basis points. Looks like there might be a little bit of selling about to happen later on in the session today as well. Plenty of comments from Fed speakers. John Williams saying we still have a ways to go on the journey to get inflation back to a sustained 2%. And then other asset classes, well, gold continues its march higher as well. It's well above $2,000 an ounce right now, 2,046, up another 10%, 0.1 of 1%. And we have Brent crude at 82.21 a barrel. Do stay tuned. This is Bloomberg Daybreak Middle East and Africa. This is Bloomberg Daybreak Middle East and Africa. Our top stories this morning. Asia stocks gain after the S&P 500 and Nasdaq 100 finished February at fresh records. The Fed weighing data showing U.S. underlying inflation rose in January at the fastest pace in nearly a year. President Biden says he remains hopeful about a temporary pause in fighting between Israel and Hamas, but that it's unlikely to begin by Monday. Plus, in our monthly special programme, we take a deep dive into the challenges facing Nigeria's economy as a jumbo rate hike fails to stem the currency's decline. Africa Amplified coming up in 60 minutes. It's just gone 8:30 a.m. across the Emirates. I'm Bonnie Quinn in Dubai. Let's have a look at how we're shaping up for the Friday trading session across the world. Well, it looks like we are in the green, at least futures for the United States pointed higher after a day which saw the S&P 500 rise 0.5%, the Nasdaq 100 up 1%, following hotter inflation data than perhaps the Fed would have liked. All eyes will be looking at Fed Chair Powell's testimony next week for any more insights we can glean into the Fed's thinking. And then the 10-year yield 4.24, Brent crude 82.21. Let's have a look at the stickiest part of the inflation picture right now. That's super core services. Fed Chair Powell last April brought this up as one of the metrics that the Fed is really using. It's going to have to come down, but it's not going to come down anytime soon. Look at that, at the highest in January in many, many months. Let's check in now on that session in Asia. Avril Hong is in a Singapore studio. Avril.
Yeah, Vonnie, we're seeing risk appetite improving in the Asia-Pacific as well. That U.S. data clearing a lot of doubts for investors. Japan leading gains today, but the Hang Seng Tech is also well in the green, led by Meituan. And that's despite signs of a price war emerging among Chinese tech companies the day after Alibaba slashed prices for its cloud services. JD.com following suit, investors shrugging that off. We're also seeing them shrugging off the Chinese factory services data, showing the official PMI in contraction. Investors looking ahead to potential policy support from Beijing with the National People's Congress getting underway next week, Vonnie.
April, thank you. Yes, we'll be looking forward to that. Well, sticking with China, top leaders have pledged to hit their key economic targets as the 24-member Politburo met ahead of next week's National People's Congress. Our Chief North Asia correspondent Stephen Engel looks at what's in store for leaders gathering in Beijing.
The National People's Congress, or NPC, is China's annual session of parliament, convened usually every spring in the Great Hall of the People next to Tiananmen Square in central Beijing. Essentially, the NPC sets the political agenda for the year ahead, when the nearly 3,000 delegates from around the country get their marching orders on day one in the form of a lengthy work report from Premier Li Qiang. While regarded as the highest organ of state power, the NPC nevertheless operates under the direction of the Communist Party of China. The NPC, by design, legislates and executes the directives of the party. The roughly two-week affair is colloquially known as Liang Hui, meaning the two sessions, as the NPC is preceded by a gathering of the Chinese People's Political Consultative Conference, or CPPCC, an advisory body supposedly representing views from the broader society and business community. Even though party membership is not required to be in the CPPCC, it is nevertheless directly supervised by the Communist Party.
Well, San Francisco Fed President Mary Daly says the central bank is in the ready position to adjust rates when needed. But she also told Bloomberg's Wall Street Week that consumer strength is keeping policymakers alert for sustained price pressures.
Consumers have just stayed in the game. They continue to spend. They continue to want to participate in the economy, and that's spurred growth, ongoing growth, and that's kept inflation a little bit higher for longer than we would have thought. But I still think overall the news is good. And yes, we absolutely see the challenges that families face when they have to pay higher borrowing costs. But we also know that what they really want us to do is bring inflation down. There is no place I go. I have a very big district, 9 states, but you can travel anywhere in the United States, hear the same thing. What's your number one problem? Inflation. That's what people are focused on, and that's what our job is.
For people in financial media and on Wall Street, the number one issue is rate cuts.
Yes, that is their number one issue. But we work for the American people, not necessarily not for markets. So,
but explain it to in your summary of economic projections, the last one. You have 3 in for the year. That's a projection. It's not a promise. And some people think you should have more. Maybe some people think you should have less. Why are we talking about rate cuts at all, given the strength of the economy? I mean, the economy seems to be doing just fine with the rate cuts you've put in place.
So we put a projection out about what we think we'll need to do if the economy evolves as we expect it to. So what's the expectation? Inflation continues to come down gradually. The labor market and the economy slow but don't tip over. And then it would be appropriate, as inflation comes down, to bring the nominal rate of interest down to make sure we're not holding on even tighter, because we want to avoid the following. We want to avoid holding on all the way to 2%, putting policy very tight, and then cause an unnecessary downturn that you give people lower inflation, but you cost them their jobs. So that's a balancing act that means we have to be calibrating. So I want to just be clear, though, you don't see many Fed officials, including myself, talking about rate cuts. You see us talking about restoring price stability, bringing inflation down, being data dependent, looking at the full balance, being patient and methodical. So I do think that message is clear. It's not always what people necessarily want to hear, but it is a clear message that we've been on.
There is a perception on some people's part that maybe the Fed was a little slow in getting started on the rate hikes, so you could have moved a little earlier. How do you avoid that problem on the way down, being slow on the way down? You said you don't want to hold all the way down to 2% and run the risk of a recession, but how do you know that you're on time with the cutting?
there is no imminent risk to the economy faltering, so we want to make sure we calibrate. So we're balancing two objectives. If we let go of the reins on the economy too quickly, inflation gets stuck, and that actually takes that scarring effect we just talked about for people, and they have it for the rest of the decade or 5 years, or it gets into inflation expectations. All those things that we don't want to happen. Plus, it's a very painful tax on those who can least afford to bear it. The other option, though, is we hold on too long, and then the economy tips over, which obviously it hasn't done yet, but we want to avoid that. So that is a delicate balancing act, and it's why you keep hearing me and others say we're data dependent, we're not data point dependent, we're looking at the full complement, and we are agile, and we're sitting in what I call the ready position. We are ready to make moves and adjust as the data demand us to do, and I think right now the economy and policy are in a good place to do that.
San Francisco Fed President Mary Daly there, speaking with Wall Street Week host David Weston. Fatty Gendy, Senior Fixed Income Portfolio Manager at Arkham Capital, joins us now here in Dubai for more on this and, of course, on Egypt, where you were part of the central bank for some time. Do talk to us, though, first about the sticky inflation in the United States and how it's going to impact the Fed's moves, which, of course, have a ripple effect throughout this region and every other.
Absolutely. So we were of the view that the Fed will cut rates in the second half of the year 2 to 3 times, so less than what the market was projecting when there was a market euphoria of 150 basis points of rate cuts. We've now seen the market come down to that expectation of ours at 90 basis points. And the premise of our view was that inflation will indeed be more sticky, and as such, it will take time, for the Fed to feel comfortable in terms of cutting rates. What it means for the region is that as the Fed does cut rates in the second half of the year, this should be positive for the region, should be positive for the MENA fixed income space, especially as we consider, as we wrote in our note, that MENA fixed income currently offers a yield of north of 6%. So already there is a sufficient carry in the space to offset any negative moves in rates or spreads.
When you say MENA fixed income, be a little more specific.
Sure.
It's not every place in the region, right?
Absolutely. So our focus is on, we're talking about the GCC as well as some of the dollar bonds out of the likes of Egypt and Jordan and Morocco, and so the average yield on that index being around 6.2% provides that buffer to take into account further stickiness in the inflation.
Egypt is a difficult one, though, right? Aren't there risks associated with Egypt's bonds?
Absolutely, and we've seen how delays in reforms by Egypt in the past have cost Egypt Eurobond market access and have also weighed on valuations of Egypt's dollar bonds. More recently, we've become more bullish on Egypt as we felt that the country has increased in its geopolitical importance, and there was talk of an expanded IMF program from $3 billion to $10 billion. Now, once we've had that Ras Al Hikma deal from last week, that has been a game-changing deal for Egypt. It is the single largest FDI transaction in the country's history. It represents 9% of GDP and is equal to over 3 years' worth of typical FDI flows. So that's a mega deal that is very positive for Egypt credit, and it's not only large for Egypt, it's large for the UAE. With the UAE, this represents 6% of its economy and its total FDI outflow for all of 2022.
Fatty, when do we start actually seeing a material impact on the ground in Egypt?
So I think the next step for Egypt to regain investor confidence is to act on the FX. Now they've signed a mega FDI deal. There's an IMF deal in the works as well. The next step is for Egypt to act on the FX. The FX has been pegged basically at $30.9 in the official market, and it's trading at higher levels in the parallel market and in the NDF market. And the IMF has been clear that to get the disbursements, Egypt needs to act on the pound. What that may look like, is it going to be a free float of the currency? Will it be a devaluation? A one-time devaluation is yet to be seen. But we think this is the next step. And if Egypt acts on the FX, that should catalyze further gains.
What should it be? I mean, you worked at the central bank.
So our view is that ideally it would be a free float of the currency. We think it will be a step devaluation from the current official rate of 31 to 40 to 45 on the dollar. And if this happens, this should unlock IMF funding and close the gap between the official rate and the parallel market.
Why would a free float work this time, though, when it hasn't in the past?
So We would want to see a free float, as that would lead to an easing of capital controls. We would see two-way volatility in the currency, and that would give investors confidence to commit not just to the Egypt dollar bonds, which is our focus, but as well to the Egypt local currency debt. Will they do a free float of the currency? They now have the firepower to handle that, but we think for the time being it might be a devaluation as opposed to a full free float of the FX.
And Fadi, interestingly, you're also really just taking positions and putting money to work in places like Angola, Nigeria, Kenya, but each has their own idiosyncratic issues, right? We're going to be taking a big look at Nigeria a little bit later on in Africa Amplified. Talk to us about why these particular markets are attractive.
Absolutely. So in the current context of fixed income, these are markets that provide in certain cases double-digit yields on dollar bonds. A case in point is Egypt. A case in point is Angola as well. And as the Fed cuts rates in the second half, we think, this will further catalyze the EM space and will further open up a Eurobond market access for some of these previously distressed names. A name such as Kenya, which was up until recently a default candidate, was recently able to tap the Eurobond market and refinance its upcoming 24s. And our view is that, for example, like a country like Egypt, if it takes the right steps, it too will regain Eurobond market access and be able to refinance bonds in the next 6 to 12 months, which should create a virtuous cycle for some of these distressed EM names.
So there's about a 200 to 300 basis point spread for some of these countries. It seems like perhaps that's not enough of a reward, but obviously somebody's done the math and that's what it is, right?
Yes, absolutely. So a country like Egypt, when we published our note on Monday, was offering a 200 to 300 basis point pickup over single B emerging markets like Kenya and Angola and Nigeria. Since then, just over the span of 1 week, we've seen a furious rally in Egypt, and it's now compressed and it's almost trading flat to the other single BEMs, which we think now is fair. There could be scope for further gains, but they may be more limited from here on out.
Fadi, when would your prediction be for a devaluation?
Ideally, we would want to see it ahead of Ramadan, which is, 10 days away, because when there is a devaluation, there's an impact on food prices. Now the country has already received $10 billion from the UAE, so it has the firepower to handle that deval. Will they do it ahead of Ramadan? We would like to see that to unlock the IMF, or they might, delay following that.
Fadi, thank you. We'll be watching out for that over the next 10 days. That's Fadi Gendi, Arkham Capital Senior Fixed Income Portfolio Manager. A Dubai-based developer is to spend $21 billion to build 2 new luxury neighbourhoods in the city, capitalising on the booming real estate market. Emaar Properties is starting sales of the developments, which will total 140 million square feet. The project will be costlier than the company's signature downtown Dubai development. Can't wait to see that one. Plenty more still ahead right here on Daybreak Middle East and Africa. This is Bloomberg.
It's a huge week ahead in politics. On March 5th, it's Super Tuesday, and former President Trump is looking to cement his place as the Republican nominee. Then, 2 days later, as the border, the economy, and the November elections dominate the headlines, President Biden will deliver his State of the Union address. Balance of Power's Joe Matthew, Kaylee Lyons, and Bloomberg's top political analysts will bring you live global coverage of both events, starting Tuesday, March 5th. Bloomberg. Context changes everything.
Ghana's parliament has passed a tough new bill that seeks up to 3 years in prison for people identifying as LGBTQ. Ghana is the latest African country to pass draconian laws aimed at the community after Uganda introduced harsh new measures last year. Let's bring in Bloomberg's Ondiro Oganga, who's in Kigali, for more. Ondiro, what kind of reaction has this bill received so far?
Vonnie, a lot of people are heartbroken, activists, members of the LGBTQ community, and some Ghanaians are not just heartbroken, but they're also very disappointed in the bill. According to LGBTQ Rights Plus Ghana, they've termed it as a hate bill, and their director says that if the president assigns it into law, then he will be ascending to violence and discrimination against people from the queer community. Weighing in on this matter, the U.S. State Department spokesperson Matthew Miller says that this bill seeks to criminalize anybody identifying or associating with LGBTQ without reporting them. And he says that the International Business Association has said that this kind of discrimination is not only detrimental for business, but also for economic growth. On the other hand, Sam George, who was one of the proprietors of this bill, very vocal against anti-LGBTQ, says this criticism is very myopic. Uganda has done the same rodeo, and they seem to be just fine. And he says that businesses that come to Ghana are there purposefully to do business and make profits.
Well, Ondiro, what happens after Parliament passes this bill exactly?
In the next 7 days, the president will be expected to sign it into law, but also very important to remember that when President Nana Addo Dankwa Akufo-Addo came into power, he was very hard on LGBTQ, said no such thing will happen under his reign. Over the years, he softened his stance. When Vice President Kamala Harris was in Ghana, President Addo Dankwa said that Parliament was going to do the responsible thing. And this restraint might be coming from what happened in Uganda, because last year, May, Uganda signed an anti-LGBTQ law, and we saw the weight of the world crashing on them. The U.S. terminated their preferential trade status, and also the World Bank cut funding. And to put this into context, Ghana is in the process of restructuring their debt. They've secured a $3 million bailout package from IMF, and the World Bank has earmarked $900 million for economic recovery. All this could be in jeopardy, and President Nana Addo Dankwa knows this. He's been in politics long enough to know the crushing weight of this bill, but he also knows that despite the choice he makes, it's Ghanaians that will have to live out the consequences.
Yeah, for sure. Ondiro, thank you for that. Bloomberg's Ondiro Oganga. Well, let's take a look at some of the big corporate stories that we're watching today. Shares of New York Community Bancorp plunged in late trade after the lender took a $2.4 billion hit to earnings. It's also, with its loan identified weaknesses review process, reigniting a drama that erupted at the end of January when it slashed its dividend and stockpiled cash to cover troubled debt. The bank has named new leadership to navigate the turmoil, with Alessandro Dinello taking over as CEO. Bloomberg has learned that ExxonMobil will cut some traders' salaries as part of an overhaul of pay structures. Sources say some were informed the move would align their pay with industry norms. They say in some cases the cuts could be offset by higher bonuses. ExxonMobil is overhauling its trading business to better compete with BP and Shell. Plenty more still ahead right here on Daybreak Middle East and Africa. This is Bloomberg. Alexei Navalny's funeral is currently taking place in Moscow. These are live shots of Moscow right now. The Russian opposition leader, who died in prison earlier this month, is being buried in the city's Borisov cemetery following a funeral service at a church in the southeast of the city. Navalny was 47 when he died at the maximum security prison camp, where he was serving 19 years on extremism charges. Once again, live pictures as Alexei Navalny's funeral is held in Moscow. Shares in Saudi Arabia's largest bank have outperformed regional peers and global rivals in the 8 years since the Crown Prince began liberalising the economy. Let's get more with our equities reporter now, Farah El Bahrawi. So, Farah, why has this stock soared?
Absolutely. So, Vani, it was up 270% over the past 8 years, which was when Crown Prince Mohammed bin Salman announced Vision 2030. This bank is a beneficiary of that. It's benefited from a boom in mortgages as more home ownership is being promoted, as well as government mega projects on the loan side, and the growth in population in general. And now it's set to benefit even more with Federal Reserve rate cuts on the table. And you might wonder, how is a bank benefiting from lower interest rates? Our Bloomberg Intelligence analyst, Edmund Christos, saying that they will be able to get more cheap deposits as well as issue debt more cheaply. So that's another thing that will benefit Al-Rajhi in its growth plans.
So it may continue to soar. Are analysts suggesting that that might happen?
Well, Morgan Stanley analysts say that it is a long-term winner in the Saudi banking sector, but they do say that the valuations currently reflect it. Vani, this bank trades at multiples close to Google and Meta than it does to JP Morgan or HSBC.
Wow.
So it's an expensive stock to own. And while it made $8 billion in revenues last year, Citi made 80 billion revenues last year. So there's clearly a little bit of a difference on the earnings front, but it's almost pretty much the same size as Citi and the biggest one in the Middle East and North Africa.
Oh my gosh. Farah, you always find these great stories for us. We will check back in with you in an hour. You never know what you might have come back with in an hour's time. That is Farah El-Bahrawi joining us there, equities reporter. Well, plenty more is still ahead. Jennifer Zabasaja joins me in the next hour from Johannesburg. Let's take a quick look at where we stand markets-wise now as we head into the trading day across the Middle East and Europe and the United States. We have futures pointed higher in the United States. The S&P, of course, don't forget, rose 0.5% yesterday. The Nasdaq was up 1%. It was a pretty decent day in spite of that inflation data, which came in hot. Now, it was as expected, but it was nonetheless a hot print. Looks like we're going into Europe session as well, higher for the day. Do stay with us. This is Daybreak Middle East and Africa.
This is Bloomberg Daybreak Middle East and Africa. Our top stories this morning. Asian stocks gain after the S&P and NASDAQ 100 finished February at fresh record highs. The Fed weighs data showing U.S. underlying inflation rose in January at the fastest pace in nearly a year.
President Biden says he remains hopeful about a temporary pause in fighting between Israel and Hamas, but that it's unlikely to begin by Monday.
Plus, in our monthly special program, we take a deep dive into the challenges facing Nigeria's economy as a jumbo rate hike fails to stem the currency's decline. Africa Amplified is coming up later this hour. It is just past 9 a.m. across the Emirates, 7 a.m. here in Johannesburg. I'm Jennifer Zabasaja.
And I'm Bonnie Quinn in Dubai, and let's take a look at how we're shaping up for the Friday session. It's green arrows all across the board, it seems like. We had the S&P 500 up 0.5% and the Nasdaq 100 up 1% in the Thursday session. It looks like futures are pointed higher. Treasury yields came off just a little bit, a bit of treasury buying as well. And then we are seeing crude higher, but at pretty muted levels, 82.19 for a barrel of Brent. Let's take a look at this chart, because this is where the problem is for the Federal Reserve. It is super core services. We're not seeing inflation come down in super core services. It rose quite substantially, in fact, in January. Jen.
Yeah, that's right, Vani. Look, let's take a look at the MSCI index for emerging market stocks. They're starting the month up. Definitely up for a third straight day, actually, if we're taking a look at it right now, and erasing its losses for the year. And we're seeing the rally really follow Thursday's boost, which came from U.S. PCE data that came in line with estimates. And what we saw for this gauge in particular on Thursday, the jump added to the 4.6 rally in February. That performance last month sealed the title for the biggest February rally for the EM equities gauge in over a decade, since 2012. So definitely a good February for EM, starting off March pretty great as well. Let's check in, though, on how markets in Asia are faring. Avril Hong is in our Singapore studio. Hey, Avril.
Yeah. Hey guys, we're looking at risk appetite improving in the region. The U.S. data clearing much of the uncertainties for markets, and we're seeing the Nikkei on track for a fresh all-time high. That being said, the Japanese yen is erasing much of the gains from yesterday after BOJ governor's comments, and that seemed to be tempering the expectations of an exit of negative interest rate policy come March. Let's flip the board and take a look at what we're seeing in Chinese tech names, because that is also where that risk appetite seems to be coming through. Meituan surging today 10%. This is the biggest move in at least a year, I believe. And we're also seeing, despite signs of a price war emerging among cloud service providers, investors are shrugging that off, along with China factory services official PMI showing the 5th straight month of contraction. As I say, risk appetite improving after the US data. Guys.
Yeah, it's across the board, it seems, Avril. Thank you. That's Avril Hong there in Singapore. Well, as Avril said, stock traders in risk-on mode as the Fed's preferred inflation gauge met expectations. U.S. stocks ended February at fresh highs. Joining us now is Bloomberg Intelligence Chief Equity Strategist Gina Martin-Adams. Gina, is there anything that concerns you at the moment? We even have the VIX just at 13.
You know, I think that what is happening in the equity market is really reflective of a couple of things. First, earnings are just pummeling expectations. So when we look at fourth quarter earnings season for the S&P 500, we're looking at nearly 8% earnings growth versus at the start of the year, analysts were expecting less than 2%. So very, very strong earnings growth. Some of that is because of the inflation deceleration. So any sort of news that comes out that suggests consumers still going to spend, which we did get that yesterday as well, spending maybe not as strong as we had hoped for, but still pretty steady, and income growth better than expected, generally sets up for pretty stable conditions for spending, along with inflation that continues to decelerate. Even though the month-over-month number was a little bit strong, the year-over-year numbers are still showing a pattern of deceleration, and that's enough to support margin growth. So you've got this sort of two-pronged positive news from earnings as well as the economy coming in to help equities. And frankly, as long as that continues, it's generally a pretty supportive condition for risk-taking.
Gina, in terms of, this rally broadening out, I mean, we're really focused here, though, on equities. I mean, are you, though, expecting this to potentially broaden out past equities to other asset classes?
You know, I think it does broaden out within the equity market first. I mean, equities are the risk asset in the multi-asset portfolio. So as long as risk is improving, it probably broadens to other riskier areas of the world. I think that it is supported right now by your note that emerging market stocks are starting to participate in this rally. So far, this has been really a developed market phenomenon. Emerging market stocks have largely trailed recovery in developed market stocks, with the exception of a few regions, notably India, of course, has performed very, very well. But stocks here in the EMEA, as well as Latin America, have not performed as well. And so there's some opportunity for catch-up trade to emerge in emerging market stocks. Developed market equities as well are still not back to their former peak levels. So we're talking about 3% from former peak for developed markets outside of the U.S. So there's still plenty of opportunity for broadening in the U.S. And then the bond market, as sort of the risk-off trade, of course, has the opposite experience. The bond market creates this sort of volatility for the equity market in general, but risk assets tend to perform best in environments where economic growth is recovering and earnings growth is accelerating.
So you just mentioned the different geographies. What about within the United States? Yep. Are there different sectors that you're perhaps keeping your eye on now?
Yeah, there's sectors and capitalizations that I think are really important to watch. Right now, we're watching breakouts emerging in the healthcare sector, something that really hasn't been discussed much as we've been so captivated by tech and AI. The healthcare stocks in the S&P 500 actually broke to new highs over the course of the last week as well. We're seeing more breakouts in industrials. More than 50% of industrial stocks posted new all-time highs last week alone. Within financials, we're starting to see breakouts as well. So we are starting to see the broadening trade in large caps. And then within small caps did start to recover over the course of the last week. We started to see small caps participate even more. This is on the heels of a really strong rally in small caps that we saw emerge in the fourth quarter that appeared to stall a little bit to start this year, but it does appear to be re-engaging as of the last week or two.
Bloomberg Intelligence Chief Equity Strategist Gina Martin-Adams with us in Dubai, and what a pleasure. Thank you. Joining us now for more context is Nadia El-Balassi, market analyst at Equity Group. Nadia, I have to ask you, since we just spoke with Gina, do you agree with everything Gina said? Are you seeing anything else that might sort of change your perspective a little bit?
Yes, I agree with what Gina has spoken about, the earnings which have been robust this season. And, Alarian, he did mention that listen to what companies have to tell us, and they are telling us that we are strong, their projections are really strong, their revenue streams are really strong. This is really a big boost for the economy, and it's also being reflected in GDP numbers that have surpassed expectations. We're seeing in Q3, we saw 5% growth in the U.S. and then followed by 3.3% growth in the U.S. So all these projections, they really do sustain a hot stock market and robust growth in the U.S.
So then, Nadia, hi, this is Jennifer in Johannesburg. What does that mean then for bonds? Will we continue to see equities outperforming bonds for the foreseeable future?
So for now, we're definitely seeing equities, surpass expectations. They're flying with colors. We have record highs for the S&P 500, for the Dow Jones, and yesterday for the NASDAQ as well. We have entered a bull run, so it's only clear to see that it's sustainable. As for bonds, corporate bonds also overnight, they hit record sales. So we do have a record high bonds issuance, and we do have record highs equities.
What about other areas of the world? So China, for example, we're obviously looking towards the NPC. Are you anticipating anything new out of that might interest you in China markets?
So we are seeing actually a lot of outflows from Chinese stocks because of the situation happening there. Property sector slump, housing market crisis. We're seeing a lot of issues happening even in the political area of things. So for China, we do anticipate that 2024 is going to still be a very hard year, especially as we continue to see outflows from Chinese stocks and also as it struggles with foreign investments.
Nadia, in terms of asset allocation, what is most appealing to you and your team right now?
So we're seeing a lot of inflows go into ETFs, gold ETFs, especially amid the geopolitical tensions that we're seeing, and as well a lot of inflows going into cryptocurrencies, which have taken a lot of favor of investors, especially after the Grayscale and BlackRock ETF approval.
What are you seeing in the commodity markets?
So in the commodity markets, we agree with the wider market that gold prices will surpass 2,100. We've already seen yesterday 2,050. Gold is a standalone investment safe havens, especially amid all these geopolitical risks and other risk factors that we're seeing, for example, China's woes, So for gold prices, we still see a projecting of upward trajectory for gold. For oil prices, we are seeing a little bit fluctuations between the $75 to $85. The Red Sea disruptions are going to add on to gains for oil prices, but what's going to cap that is OPEC plus cuts that have already been priced in by the markets, unless they, in their March meetings, they announce bigger cuts, then oil prices are going to stay in this narrow range between $75 and $85.
Yeah, and we've been seeing that. Nadia, we were talking to Gina briefly about emerging markets participating in the rally as well. We touched on China. Is there anywhere else you're looking globally that you think is going to be benefiting from really what we're seeing is a bit more risk-on appetite from the investment community?
So from the risk-on appetite, we're seeing a lot of inflows go to India, go to Japan. We've seen the Nikkei, at record highs as well. It tells us a lot about what's going on in the real economy in Japan versus, what's going on in China. So a lot of outflows going outside of China into Japan and into India and also into Saudi Arabia. So this is the asset allocation changes that we're seeing in the market.
Yeah, and we talked to our Farah Al-Bahrawi about that quite often. Thank you so much, Nadia El-Bilasi, analyst at Equity Group, joining us in studio in Dubai. Great to have you on this morning. All right, still ahead, we'll get the latest on Gaza as a deadly incident around an aid convoy complicates ceasefire talks. President Biden now saying a ceasefire is unlikely to begin by Monday. More up next. This is Bloomberg. Iran is holding parliamentary elections today. It's a vote that's being watched at home and abroad as a test of public support for the country's handling of protests and role in the ongoing Israel-Hamas war. Joining us now is Bloomberg's Patrick Sykes, joining us from Istanbul. So, Patrick, what exactly should we be watching out for with these elections?
Morning. Yes, I think the headline is look for turnout, not the results themselves. What you need to know about elections in Iran is there's no sort of political parties as we might recognize them, and also all individual candidates have to be vetted by an unelected body. So there's a lot of control over who gets to run, and then the way they organize themselves isn't really something that I think we're familiar here with as observers. But turnout is important. Turnout has been part of the state's sort of self-conception of itself since the 1979 revolution as an Islamic republic. It does like to emphasize that republican credential. Recently, turnout in recent elections has been falling. It's hit record lows in both presidential and parliamentary in the last rounds. And this time around, Khamenei, the Ayatollah Khamenei, the supreme leader, has been particularly vocal about urging people to go out and vote, urging people to cast as many votes as they can so that they can give a signal of strength to Iran's enemies and show that people are engaged with the regime. That, of course, may be a challenge after the 2022 protests we had, and now more recently the situation in Gaza and the war in which Iran is obviously playing a big role.
And Patrick, besides the parliamentary elections, there's also a ballot on the body that picks the supreme leader. Why is this significant?
That's right. This body is called the Assembly of Experts. It's relatively small and the competition is particularly weak. I think there's less than 2 candidates running for each seat. But this matters because the current incumbent supreme leader, Khamenei, he's 84 now. There's no clear successor to him, and this body is going to sit for a term of 8 years. So it's fairly likely that they're going to have to deal with a succession period in their term. That means they're going to have to, for only the second time in their history since their foundation after the revolution, they're going to have to pick a supreme leader. That figure, that post, is of course, holds absolute power in the country. So it's extremely significant for the country, for the region, and for, I think, world geopolitics as well. Again, the people who run for it are very much vetted, so it's all a fairly controlled process. But sooner or later, that body is going to have a really significant role to play.
Patrick, thank you. We'll be following your reporting and, of course, check in with you again Monday after it's all over. That's Bloomberg's Patrick Sykes. And President Biden says he remains hopeful about the prospects for a temporary pause in fighting between Israel and Hamas, but that it's unlikely to begin by Monday as he had originally sought. He cautioned that a deadly confrontation earlier Thursday around an aid convoy in Gaza will complicate those ceasefire talks. Joining us now is Bloomberg's Stuart Livingston-Wallace. So it's obviously going to complicate those talks, Stuart, but we're seeing scenes like this sort of on a near constant basis, perhaps not this concentrated, but it's a difficult situation, to say the least. When can we anticipate that there might be some kind of breakthrough on these ceasefire talks?
Yeah, certainly not Monday, or I think everyone, including Biden now, would be surprised if that is the case. I mean, in terms of the noises we've been getting, there's just no certainty there. So we're thinking probably weeks, but again, we know Israel's given this deadline of Ramadan, hostage release by Ramadan, or we're going to go into Rafah. But there's still no clear plan for how you're going to get the civilians out of that area. Where exactly do they go to? We know the north of Gaza is in pretty bad shape. We know that the aid convoys are having real problems getting in. And obviously when they do get in, you've seen the scenes from that aerial footage there from the IDF of what potentially could happen. So how do you get enough supplies, particularly things like tents, medical supplies and food for over 1 million people in a sort of a displaced scenario? And there's no real clear solution for that.
And Stuart, I mean, happening at the same time, we're hearing about Saudi Arabia and other Arab states really trying to put together a peace plan for this particular part of the world. I mean, how much legitimacy is there here, and is your expectation that we're actually going to see something in the short term?
I mean, I think we're all quite cautious on this, and here's the fundamental disconnect. You've got most of the international community would like some sort of form of Palestinian statehood, or at least a path to Palestinian statehood at some point in the next several years. You've got Israel now in a position where I think domestically it's going to be very hard to sell that to the electorate. October the 7th really changed public opinion in Israel about what the future might look like. And I think Netanyahu, or indeed any other leader in the current environment, would really struggle to sell that. So there's the fundamental problem. At the same time, the Arab states can't move forward, or will find it very difficult to move forward in terms of normalizing relations with Israel, which is fundamentally what most of them want to do, without some sort of path to Palestinian statehood. So that's the fundamental problem. There's no obvious way out of it at the moment, and I think all sides probably say we're going to have to wait for some sort of ceasefire, hopefully a permanent one, before they can make any headway on that particular issue.
Absolutely. We'll be paying close attention to that. Bloomberg Stuart Livingston Wallace, appreciate you joining us as always. All right, plenty more still ahead. This is Bloomberg Middle East and Africa. San Francisco Fed President Mary Daly says the central bank is in the, quote, ready position to adjust rates when needed. But she also told Bloomberg that consumer strength is keeping policymakers alert for sustained price pressures.
Consumers have just stayed in the game. They continue to spend. They continue to want to participate in the economy, and that's spurred growth, ongoing growth, and that's kept inflation a little bit higher for longer than we would have thought. But I still think overall the news is good. And yes, we absolutely see the challenges that families face when they have to pay higher borrowing costs. But we also know that what they really want us to do is bring inflation down. There is no place I go. I have a very big district, 9 states, but you can travel anywhere in the United States, hear the same thing. What's your number one problem? Inflation. That's what people are focused on, and that's what our job is.
For people in financial media and on Wall Street, the number one issue is rate cuts.
Yes, that is their number one issue. But we work for the American people, not necessarily not for markets. So,
but explain it to in your summary of economic projections, the last one. You have 3 in for the year. That's a projection. It's not a promise. And some people think you should have more. Maybe some people think you should have less. Why are we talking about rate cuts at all, given the strength of the economy? I mean, the economy seems to be doing just fine with the rate cuts you've put in place.
So we put a projection out about what we think we'll need to do if the economy evolves as we expect it to. So what's the expectation? Inflation continues to come down gradually. The labor market and the economy slow but don't tip over. And then it would be appropriate, as inflation comes down, to bring the nominal rate of interest down to make sure we're not holding on even tighter, because we want to avoid the following. We want to avoid holding on all the way to 2%. They're putting policy very tight, and then cause an unnecessary downturn that you give people lower inflation, but you cost them their jobs. So that's a balancing act that means we have to be calibrating. So I want to just be clear, though, you don't see many Fed officials, including myself, talking about rate cuts. You see us talking about restoring price stability, bringing inflation down, being data dependent, looking at the full balance, being patient and methodical. So I do think that message is clear. It's not always what people necessarily want to hear, but it is a clear message that we've been on.
There is a perception on some people's part that maybe the Fed was a little slow in getting started on the rate hikes, so you could have moved a little earlier. How do you avoid that problem on the way down, being slow on the way down? You said you don't want to hold all the way down to 2% and run the risk of a recession. But how do you know that you're on time with the cutting?
There is no imminent risk to the economy faltering, so we want to make sure we calibrate. So we're balancing 2 objectives. If we let go of the reins on the economy too quickly, inflation gets stuck, and that actually takes that scarring effect we just talked about for people, and they have it for the rest of the decade or 5 years, or it gets into inflation expectations. All those things that we don't want to happen. Plus, it's a very painful tax on those who can least afford to bear it. The other option, though, is we hold on too long, and then the economy tips over, which obviously it hasn't done yet, but we want to avoid that. So that is a delicate balancing act, and it's why you keep hearing me and others say we're data dependent, we're not data point dependent, we're looking at the full complement, and we are agile, and we're sitting in what I call the ready position. We are ready to make moves and adjust as the data demand us to do. And I think right now the economy and policy are in a good place to do that.
And that's it from me. Our monthly special Africa Amplified is up next with Jennifer Zapasacha. This is Bloomberg.